Hi everyone, in this video we will be going over A-Level Accounting 2022 October-November paper 2-3 question number 2. This is a structured paper 2 which consists of 4 questions. 2 of them are of 30 marks and 2 of them are of 15 marks, and we're also given a total time limit of 1 hour and 30 minutes. And question number 2 is of 15 marks, which means that ideally we should be spending about 15 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 15 minutes. So without any further delay, let's get started. Darius and Ivan are in partnership, sharing profits and losses in the ratio 5:3. The following balances were extracted from the partnership's books of accounts at 31st July 2022. Alright, then on 1st August 2022, the partners agreed to admit Karim into the partnership on the following terms. Karim was to introduce a total capital of 48,000, and this consisted of fixtures and fittings valued at 9,500, with the balance to be introduced into the partnership bank account. So what this means is that Karim will inject 48,000 worth of additional capital while joining this partnership, and out of this 48,000, 9,500 will be fixtures and fittings. So the remaining value will be cash that will be deposited into the partnership bank account. So let's figure out the remaining value for bank. Karim will have to inject 48,000 minus 9,500, which results in the value of 38,500. So he will have to put 38,500 into the partnership bank account. Then future profits and losses were to be shared between Darius, Ivan and Karim in the ratio 5:3:2. Okay, out of 10 parts, 5 parts will belong to Darius, 3 parts will belong to Ivan, and 2 parts will belong to Karim. And goodwill was to be valued at 36,800. Goodwill was not to be retained in the books of accounts. Property was to be revalued to 135,000. Previously, the property at valuation was 127,000. So this is upward valuation. Then for the final information, we're told that obsolete inventory of 2,000 was to be written off. This means that our inventory value will be reduced by 2,000. So we have a revaluation upwards and a revaluation downwards. Alright, let's figure out the amount by which the property was revalued. That will just be the difference between the current new value and the previous value. In this case, that will be 135,000 minus the previous value, which was of 127,000. This gives 8,000. So this is revaluation upwards by 8,000, and this fifth information will result in a revaluation downwards. So that's negative 2,000. And since the positive amount is greater, there exists a profit on revaluation. Let's figure it out. So profit on revaluation is just going to be the sum of these two amounts. So that's 8,000 minus 2,000, which results in 6,000. Okay, now let's have a look at our first question. We need to prepare the partnership's capital accounts on 1st August 2022 following the admission of Karim. Okay. So whenever we are creating capital account, we always start with the opening balance, right? And the opening balance for capital account is always recorded on the credit side. So let's write it down. That will be our balance brought down. And we only write down the opening balances for our existing partners, which in this case are Darius and Ivan. So let's have a look above regarding their capital account. It is given right here. For Darius, that is 94,300, whereas for Ivan, that's 68,300. So let's copy these amounts as our opening balance. That's 94,300 and 68,300. All right. And we know that Karim is a new partner, right? And in order to become a new partner, he has to introduce a total capital of 48,000, out of which 9,500 will be of fixtures and fittings, whereas 38,500 will be of bank. And these two amounts is definitely going to increase his capital balances, which means that this should be recorded on the credit side. So let's record that. First of all, we have fixtures and fittings. That is of 9,500 for Karim. And again, he introduced an amount into the partnership bank account, which was of 38,500. Okay. And the next thing that we need to record will be goodwill. We are told that the goodwill was to be valued at 36,800. And while creating a capital account when there is an admission of a new partner, we need to record the goodwill based on previous profit sharing ratio on the credit side. And we also need to record its value based on the new profit sharing ratio on the debit side. So let's have a look at the previous profit sharing ratio. that was 5:3, which means that out of 8 parts, 5 parts belongs to Darius and 3 parts belongs to E1, right? And we are given the total goodwill to be 36,800. So let's figure out the goodwill for Darius. That will be the total amount of 36,800, out of which 5 out of 8 parts belongs to him. So the goodwill amount for Darius based on previous profit sharing ratio is going to be 23,000. Now we repeat the same process for E1. That will be the total amount of 36,800, out of which 3 out of 8 parts belongs to him. And this gives the goodwill amount based on previous profit sharing ratio for E1 to be 13,800. So let's record these two amounts in our credit side of the capital account. So that will be goodwill. For Darius, we figured it out to be 23,000. For E1, it was 13,800. Alright, the next step would be to figure out the goodwill value based on new profit sharing ratio, which is 5:3:2. Let's figure out the amount for Darius. We have our total goodwill of 36,800 and 5 out of 10 parts belongs to him. So that's times 5 by 10, which results in his new goodwill value to be 18,400. Now we repeat the same process for E1. We have 36,800, out of which 3 out of 10 parts belongs to him. So that's times 3 by 10, which results in the amount of 11,040. And for Karim, that's going to be 36,800, out of which 2 out of 10 parts belongs to him. So that's times 2 by 10, which results in an amount of 7,360. Now we need to record these new goodwill values on the debit side of our capital account. Let's do that. That's going to be goodwill. For Darius, we figured it out to be 18,400. For E1, that's 11,040. And for Karim, that's 7,360. Okay. Then we also figured out that there was profit on revaluation of 6,000, right? And this is a profit on revaluation before introduction of Karim, which means that this profit should be divided among the two existing partners, Darius and Karim. And remember that their profit sharing ratio was 5:3, which means that for Darius, he will get 6,000 and 5 out of 8 parts. So that's times 5 by 8, which results in the amount of 3,750. Now for E1, that's going to be 6,000 times 3 by 8, which results in the amount of 2,250. Now we need to record these two amounts as profit in the capital accounts of Darius and E1. And profit is something that will definitely increase the capital account balances, which means that these amounts should be recorded on the credit side in our capital account. Let's write it down. That is profit on revaluation, which was of 3,750 for Darius and 2,250 for E1. So this concludes everything that needs to be recorded in our capital accounts, which means that we can now move towards figuring out the closing balances. And since the opening balances on capital accounts exist on the credit side, the closing balance will be recorded on the debit side. So that's going to be balance CD. And this will act as the balancing figure. And in order to figure out the balancing figure, we first require the total, right? So let's figure out the total from our credit side. For Darius, that will be the sum of these three amounts. That's 94,300 plus 23,000 plus 3,750, which results in the total of 121,050. For E1, that's the sum of these three amounts. 68,300 plus 13,800 plus 2,250, which results in 84,350. And for Karim, that will be the sum of these two amounts. That's 9,500 plus 38,500, which results in 48,000. And the total will be the same on the debit side as well. So that's 121,050, 84,350, and 48,000. All right, now let's figure out the balance CD, which is the balancing figure, right? And in order to figure out the balancing figure, we need to subtract this amount from the total. For Darius, that's going to be 121,050 minus 18,400, which results in 102,650. For A1, that's 84,350 minus 11,040, which results in 73,310. And for Karim, that's 48,000 minus 7,360, which results in 40,640. All right, now the next step would be to record this closing balance as the opening balance for new accounting period. So that will be on the credit side. And remember that this year's opening balance is equal to last year's closing balance. So the opening balance for Darius will be 102,650. For Ivan, that will be 73,310. And for Karim, that will be 40,640. Okay, this concludes the capital account. We can now move towards the next part. Okay, we were given the working section right here. So instead of scribbling all over the question paper like I did in order to figure out the goodwill value, profit on revaluation, bank amount, these all should be mentioned in that particular working box so that you get the correct markings for your steps. All right, now for the second part of this question, we need to prepare the partnership statement of financial position at 1st August 2022 following the admission of Karim. And again, we are given the working section, but for my ease, I will be scribbling all over the question paper. But like I said before, you guys should be showing all of your workings in that particular box so that you get your markings correctly. Let's move towards preparing the statement of financial position. So we will start with our assets section and we'll start with non-current assets. All right, let's have a look above. We can see we have fixtures and fittings and property. So these two will be our non-current assets. Let's figure out the value for fixtures and fittings. The existing value is 44,000 and we also know that Karim introduced fixtures and fittings with the value of 9,500. So the new value for fixtures and fittings is 44,000 plus the addition of 9,500, which results in the amount of 53,500. So this is the value to be recorded in our statement of financial position for fixtures and fittings. And for property, we know that it was revalued to 135,000. So this is the value at which it should be recorded in the statement of financial position. Let's record these two non-current assets. We first have fixtures and fittings. And this is of the value 53,500. We then have property with the value 135,000. Let's figure out the total for non-current assets by adding these two amounts. That will be 53,500 plus 135,000, which results in 188,500. We can now move towards the current assets. Again, let's have a look above. So the current assets to be included will be inventory. And we know that inventory, we had absolute inventory, of which 2,000 was to be written off, which means that we need to reduce this amount of 2,000 from inventory. So let's figure out the new value. That will be 36,200 minus 2,000, which results in 34,200. So this is the value to be recorded under the heading of inventory in our statement of financial position. Then the next current asset is trade receivables with the amount of 6,300. And then we also have bank amount, right? Previously, we were given bank overdraft. So this is a negative bank balance. And we added 38,500 into the bank, which means that the new bank balance is going to be minus 12,700 plus 38,500, which results in our bank balance to have 25,800. So this is the amount to be included under the heading of bank in our statement of financial position. So we have three current assets: inventory with the value 34,200, trade receivables with the value 6,300, and bank with the value 25,800. So let's record these three in our statement of financial position. First of all, we have inventory, which had the value of 34,200. Then we have trade receivables of 6,300, and we have bank with the amount 25,800. Let's figure out the total for current assets by adding these three amounts. That will be 34,200 plus 6,300 plus 25,800, which results in 66,300. Now we can figure out total assets. That will be the sum of non-current assets and current assets, which in this case is 188,500 plus 66,300, which results in 254,800. All right, we completed the assets section. We can now move towards capital and liabilities section. We will be starting with the capital accounts. And we have three partners. So that is Darius, Ivan, and Karim. And since we have already prepared the capital account above, we will just be substituting the closing balances. So let's have a look above. The closing balance for Darius was 102,650. For Ivan, it was 73,310. For Karim, it was 40,640. So let's write down these three amounts in our statement of financial position. That will be 102,650, 73,310, 40,640. Let's figure out the total by adding these three amounts. That's 102,650 plus 73,310 plus 40,640, which results in 216,600. Okay, let's have a look above to see if we have any non-current liabilities. Okay, we are given bank loan, which is to be repaid in 2025, and we're talking about the date of 1st August 2022. So clearly this is a non-current liability with the amount of 24,000. Let's record this. We have non-current liability. And this is the bank loan to be repaid in 2025 with the amount 24,000. All right, then we have current liabilities. Let's have a look above. So we had bank overdraft previously, but clearly we now have a positive bank balance. So this no longer exists as a liability. Then we have trade payables with the amount of 14,200. And this is a current liability. So let's record this. That is the only current liability. Okay, we have trade payables with the amount of 14,200. All right, we can now figure out the total capital and liabilities. This will be the sum of capital accounts, non-current liabilities, and current liabilities, which in this case is 216,600 plus 24,000 plus 14,200, which results in 254,800. Okay. And as we can see above, the total assets value is equal to that of total capital and liabilities, which means that our statement of financial position is correct. This concludes the second part. We can now move towards the third one. We are given additional information. Partners may allow interest on capital and charge interest on drawings. We now need to state one advantage of allowing interest on capital to a partner. So when we allow interest on capital, basically the partner will receive a certain interest on their investment, which acts as a reward to them, right? So that is an advantage. Let's write it down. To reward the partners for their investment. Nextly, we need to write an advantage for partnership. So when partnership provides a reward to partners, they might be motivated or be encouraged to further invest in the partnership. Let's write it down. To encourage further investment in the partnership. This concludes the third part. We can now move towards the fourth one. We need to explain one reason why a partnership may charge interest on drawings. So when partners take interest, they need to pay certain interest to the partnership. And this is done so that partners get discouraged from taking excess drawings from the partnership, which will avoid future cash flow problems. Let's write it down. To discourage partners from taking excess drawings from the partnership, which will avoid future cash flow problems. Okay, this concludes the fourth part as well as the entire question number 2 of 2022 October-November paper 2-3. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.